more. Let's bring in Mike Feroli, chief U.S. economist at J.P. Morgan. Mike, what's your take for tomorrow? 25 basis point cut?
Yeah, I think 25 basis points has been pretty well signaled by the Fed, and that's what we're looking for. I think what will be more interesting is what Powell says in the press conference afterwards, and whether he confirms the market's expectations that there's a lot more to come, or whether he kind of says they're kind of going to be a little more data dependent. Our expectation is that Powell signals that from here on out, they're going to be watching the data perhaps a little more than they did between June and July, when they were pretty much on autopilot in terms of their rhetoric and in terms of how they were signaling for tomorrow. So that's our baseline expectation. But as I said, I think the more interesting development, I believe, will probably be the press conference.
So are you saying that the market may be set up for a disappointment here, expecting more rate cuts throughout the year?
Yeah, so we're looking for another cut in September, though I must say the data over the past few weeks does dial down the odds perhaps a little bit that we get, or maybe I should say ups the odds a little bit that it could be one and done. But as I said, we're sticking with another cut for September, and that would be it. And if that's the case, I think the market would be a little bit disappointed, not perhaps hugely disappointed. The market has already taken back expectations over the past few weeks of strongly expecting 50 basis points tomorrow to now being content with, around 25 basis points. And that happened without too much, disruption in terms of risky assets selling off or anything like that. So I think you could have, a further readjustment here of market expectations, provided that happens in the backdrop of data that looks like it did over the past month, which has, generally been pretty encouraging data in terms of the momentum of the U.S. economy here.
Charlie, is inflation going to stay low in the U.S. and allow further cuts?
I am glad you asked that. You asked me what's the risk that the market is not properly thinking about longer term. It is inflation. If you look out 3 years from now and you then try to look back and you say we had trillion-dollar deficits, we had record low unemployment, we had 3.4% wage growth right now, we had countries around the world competing with each other to cut their value of their own currency, I think we got a lot of things pushing inflation higher.
People have been saying that for years.
Yeah, I know they have, but we haven't had all those factors the way that we have them right now. And you're absolutely right. It has been a prediction that people have said for a while, but we've got it all lined up right now.
But Charlie, I guess you could push back and say a strong currency offsets some of that pressure to inflation. And just look at a snapshot of the data today. Even if we get a rate cut tomorrow, Europe, French GDP was disappointing. German inflation was very disappointing versus strong consumer confidence, strong housing data. You're not going to get a very weak currency off the back of this cut.
I'm glad you said that. The definition of inflation is a weak currency. It means the value of your currency is going down. So absolutely, the reason we've had no inflation is because the dollar's been so strong. So far, the market has shrugged off $22 trillion of national debt. But we are adding debt at a rate of over $1 trillion a year. That has not worked well historically.
Who isn't, though?
Sorry?
Who isn't, though?
And there's no inflation.
Well, we are at $1 trillion a year. We are bigger than anybody else. There is actually no other country in the world that is adding the kind of debt that we are. There is no point in history that we've added debt at this rate compared to our GDP. These are all records, uncharted territory. If you go to France and England back in the 18th century, a lot of the problems that they suffered was from excess debt that they couldn't fund.
So, Michael Feroli, maybe you can weave in your inflation forecast into a bigger question I have about what the economy is actually doing. I mean, I think the reason this cut is so controversial is there's a lot of disagreement on the street about how much weakening we're actually seeing as a result of slowing global growth and lower inflation and lower capex and that sort of thing. So what's actually happening with the outlook?
Well, I think the economy is doing better than expected, at least as of a month or two ago when the trade tensions really started to increase. I think a lot of us expected that would show up in the data. And, we have had continued weakness in manufacturing. The global side of the story still looks, plodding along. But all in all, we're not seeing things slow in an abrupt manner. So we do feel like second half, growth will be okay. Maybe we have it just a little bit shy of 2%. But I would emphasize that the number we saw in terms of the GDP report last Friday was pretty healthy in terms of underlying domestic demand. And I would say on the inflation side of things, in 2 weeks, we're going to have a pretty big upward revision to unit labor costs. So I wouldn't look for an inflation problem in the next, few months, maybe not even quarters. But I think, if you look out a few years and we continue on this path where we globally continue to run very growth-friendly policies, that should put upward pressure on inflation. But I wouldn't look for that right around the corner.
Mike, just quickly on this point about international and versus U.S. growth that, of course, Janet Yellen commented on over the weekend. Where do you stand on on that? If we do see, say, a full recession in the Eurozone, would the US potentially be able to shrug that off?
No, I don't. Well, not easily. Generally, U.S. It's pretty rare that U.S. recessions are caused by foreign growth. However, I do think that would affect the path of interest rates, and the Fed would have to be, quite a bit more accommodative than it would otherwise. And I think the very low, normal interest rates that we're seeing in the U.S., which seem to, to peak at least in the Fed cycle around the mid-twos, I think a lot of that has to do with the fact that global growth looks to be a lot slower than U.S. growth, and so I would expect that the U.S. economy would continue to grow with the European recession, but we'd probably do that with a much more accommodative monetary and perhaps fiscal stance.